Welcome to the State of the Markets podcast. I'm Paul Rodriguez of thinktrading.com.
I'm Tim Price of pricevaluepartners.com.
And our very special guest is Richard Moglen. Richard Moglen, welcome to the show.
Yeah, great to be here. Thanks for having me.
Well, it's fantastic to have you on. Richard, for our listeners who may not have heard of you, could you tell us a bit about your background and how you got involved in the financial markets?
Yeah, sure thing. So I got my start back in the late end of 2018. So I got started while I was going to the University of Maryland. And I got interested actually first because I stood by on the sidelines and watched when there was that first kind of Bitcoin craze. I forget exactly when that was, but there was a fellow student of mine in the engineering program who had traded that. He was talking about it every single day, and it was just going up, and it seemed like something that was of interest. But I had no experience in the stock market, Bitcoin, crypto, any of that. But that just kind of piqued my interest. And I think I placed a few trades, opened my first account in late 2018. Didn't know what I was doing, had no process, none of that. But there was this class at the University of Maryland where I was attending called Introduction to the Stock Market and Technical Analysis. And it's basically an honor seminar course that was in extremely high demand. I had tried to get into it a few times, but it was always booked up by the time I actually was able to sign up for classes. But it was taught by this professor, Dr. Eric Wish, who by profession, he was the director of a substance abuse research center, but for 50 years, his passion has been really for the market. So on the side, it was in his family background as well. He's basically been trading and has done extremely well. So he decided to ask the university to be able to teach this course to help educate younger students about financial markets, as well as just, compound interest, Roth IRA, retirement accounts, financial literacy as a whole. So finally, in the spring of 2019, I was able to get into this class, and it was probably, it was my favorite course that I took at the university. By major, I was a mechanical engineer, but I was spending a lot of my free time after taking this class studying trading, studying different strategies, studying charts, reading books, all of that. I fully dove in, loved it. I think it was the most notes I've ever taken in any class ever, and just had a lot of fun. And what's really unique about this class is we got to learn from somebody who's been doing it for, decades. And he really helped shorten our learning curve. I think his emphasis on risk management, the foundational processes that he have for identifying trades, his entry points, his exit points, and also just his general approach about needing to analyze your results, calculate key metrics, look back on both your winners and losers to see what you did well, what you did wrong, and incorporate that into improving over time. Just all those key principles and foundations helped me out immensely. So that's how I got my very first start in 2019. Is that class really, I think, just really ignited a love for the markets, a love for trading. I'm very process oriented, competitive. I played sports my entire life, and this kind of filled, that niche and scratched that itch as well. So that's how I got my very first, foray into the markets, is first trades in 2018, and then really getting serious in it with the class at the University of Maryland in 2019.
Right. So that's interesting that it's far more recent, and it's recent events that have led you to that. So having got passionate about the markets and trading and learned all this knowledge, you decided to put all this resource into a book called The Trader's Handbook.
That's right. I partnered since and learned an immense amount from my other co-founders at Traderline, and we've started a software, DeepView, as well. And my co-founders, one of them was a portfolio manager under a market wizard, William O'Neill, at William O'Neill and Company. He's been trading for 30 plus years. The others are a little bit younger. They're older than me, but they have their own unique styles and experiences. And we basically put together this resource, the Trader's Handbook, which is the resource that we would have liked to start with. Again, it kind of shares a lot of the principles that Dr. Wish, who I first learned from, taught in the class, risk management, which is the key to all of this. Developing an edge, developing setups, sell rules, tactics, all of this. We kind of put it all together in one place to help traders accelerate in their first few years of trading. There's a lot of great books out there. I recommend a ton, but I think what kind of the Trader's Handbook fits, in terms of a missing need, is putting it all together into building a trading system step by step, but also in an interactive way. We have exercises at the end of each chapter to help kind of emphasize, all the concepts we're teaching, and to make it, that much more interactive. We want you to apply the material that we're teaching. We don't just want, passive readers. We want to make sure it has a positive impact on your trading.
So what's the software that you create at the company?
Yeah, so we developed DeepView over the past few years, and basically it allows you to analyze charts, analyze fundamental data all in one place, instead of having to go to all these different sources to get earnings data, revenue data, as well as look at the chart. We bring it all together under one platform. It's a screener. You can look and enter criteria both on a technical basis as well as fundamental basis, find stocks that meet your criteria. And we also have a lot of unique dashboards with heat maps, risk management calculators. Basically, we're building a suite of tools that will help traders, again, just bring everything all together into under one ecosystem and hopefully save people a lot of time. We use it every single day during our workflows. So we're making sure to, we want to save ourselves time during our routines. And so we're building a lot of unique features into the platform that help us do just that. And we think will help out a lot of traders there as well.
So it's DeepView VUE. I've actually heard of it. I didn't realize that you were connected to it. That's really interesting.
Yeah, that's it. Exactly.
Yeah. Okay. Oh, right. That's really interesting. So what would you say would be the first step for somebody who would be interested in the markets? Do you think they should read a book like yours, or do you think they should sign up to something like DeepView that would help them?
I think it starts with the knowledge. The first few, really years, but especially the first year, is just about getting your toe in the water and not getting burned, and trying to accumulate and get as much knowledge as possible. I'd recommend our book. I'd also recommend How to Make Money in Stocks by William O'Neill. I'd recommend How I Made $2 Million in the Stock Market by Nicholas Darvis. Those would be great books to get started with. And then I think at the same time, what somebody who's interested in the market should do is open up an account and fund it with a little bit of money. Definitely not, as much as they could, but something enough an account that a loss, you'll feel it a little bit, but not too much that, losing that account would set you back financially. But what I do think is important, I think, there's a lot of folks who recommend paper trading, and I think that's fine for actually learning the mechanics of setting an order or setting a stop loss order. But, after that, I think graduating to real money is really important, because real money, if it's a $10 loss, a $100 loss, or a $1,000 loss, it feels different than a paper trade loss. And those emotions, impact our decision making and can impact how we, review trades and all of that. So I think my biggest advice would be to start with those three books that I mentioned: the Trader's Handbook, William O'Neill's How to Make Money in Stocks, Nicholas Darvis's How I Made $2 million in the Stock Market, and then open up an account with a little bit of money, but you kind of want to treat that as a learning account and build processes first. Processes can graduate from a $100 account all the way up to a $100,000 account, but you got to build the process, and you're going to make a lot of mistakes early on, and it's better to make mistakes with a very small amount of capital than a larger amount where it's really going to set you back. So those would be a few things that I think starting out would be really good. Books are great for building knowledge, but you really have to experience everything that those books talk about to really understand it. And it's going to take a few reads of of each of those books that I mentioned to get the most out of them. And every time that you go out and trade for 6 months, trade for a year, trade for 2 years, when you come back to those resources, How to Make Money in Stocks, the Trader's Handbook, our book, you're going to pick up new things. And that's what I think is awesome about trading is there's so many nuances, and the nuances are really what matters. And you don't necessarily have the ability to understand them until you've really experienced trades for yourself, experienced a big gap down on earnings, experienced a big gap up as well. There's things that happen, experience a bear market, experience a market correction, a strong recovery, catch your first 20 plus mover, catch your first, double in the market. All these things are actual experiences that, bring to reality a lot of the concepts that are taught in books. So I think you kind of have to do both. You have to experience trading and actually trade to learn. But books can build an excellent foundation that help connect the dots and speed up your learning curve. So those would be a few things that I think could help traders out there, newer traders out there.
Richard, should everybody trade? Can everybody trade successfully, or are there certain people that you think are congenitally just not well equipped to handle the challenge of trading in the real world?
Yeah, really good question. I think everybody should be involved in the markets in some respect, at least to invest. Trading requires, I think, a certain set of skills that, for the most part, can be learned with dedication and the will to do so. But I think there are certain folks who it feels more natural to them. A lot of the market wizards who I've interviewed on the Traderline YouTube channel, they come from sports backgrounds, they come from competitive backgrounds, and I think that helps quite a bit, especially because sports teaches us a lot about losing and working hard and building a process and all that. So I do think there's people who are more naturally suited towards trading. But I do think that if you have the will, a lot of people can get most of the skills needed. But there's also the question of time commitment. If you're someone who works full time, that's going to limit your ability to trade in certain styles that require more attention, more time in front of the computer. But when it comes to investing, being a part of the stock market, I think people should do all they can, because that's the way to build wealth over the long term. And whether it's trading or investing, you want to be involved somehow. So not sure if that perfectly answers your question, but I think there's a few things on that.
I mean, I would suggest, I think it's a great question, Tim, and I think that there are some people who just should not trade, and it's those people who treat trading like gambling and think that it's the same thing, and and they're looking at it from a point of view of excitement rather than as a business. Now, whether you can train that out of somebody is another thing. So you could take someone who shouldn't really be a trader, and if they're willing to be self-reflective and learn to be a trader, they can be. So it's a bit like saying, can anybody play the piano? Yes, but they have to kind of want to, and they have to put in the time. And if they don't want to practice, and if they don't want to correct their mistakes, they'll never do it very well, and they'll end up with a poor result. So,
and I think you're right, because you can read whatever you like in a book, but ultimately, as Richard's already alluded, there's no replacement for actual experience.
Absolutely,
so
yeah.
Theory is one thing and practice is another. It's like, everyone has a plan until they get a punch in the mouth. Exactly.
What I was going to ask about experience, I think it's very interesting that. How can I put this? For the people that we've had on the podcast, actually, your experience is probably the freshest, shall we say? Mm-hmm. If someone was to say, well, hang on, you haven't been in the markets long enough to really see the full cycles, to know exactly how to approach them, what would you say to that?
Yeah, it's a really good question. The first thing I'd say is actually during the time that I've been trading, we've kind of experienced quite a few amazing events. We've experienced the 2018 correction. We've experienced the trade wars of 2019 that caused a lot of turbulence. We experienced the March 2020 correction, the steepest correction, fastest correction in quite some time. The great recovery in 2020. We experienced the 2022 bear market. So the last 6-7 years have been really a fantastic learning experience to experience bear markets, bull markets, sideways markets, all of those all together. In addition to that, I think what's really helped my learning curve specifically is I've been interviewing market wizards and really experienced traders since 2019. And I think I've done, maybe 200 plus interviews at this point with folks like Linda Raschke, David Ryan, Mark Minervini, all these fantastic traders who have been doing it for decades. And each one of those, I've learned key lessons, and it's helped speed up my learning curve immensely. And in addition to that, I think with anyone, if there's an intense passion and focus, you're able to accelerate gaining that knowledge. And, what I do is I've built a lot of model books going back and studying the greatest stocks going back to the 90s and especially the last 25 years, building model books, analyzing the moves, identifying spots, key setups, where you would sell, where you would enter, and being really intellectually honest about it as well, trying to be, as in the moment as I can. And these are all things you can do to kind of accelerate your experience, because it's not the same as trading in real time and actually trading those names, but you can kind of learn how these top stocks perform, how they trend, how, the character of those stocks as well. So yeah, I think the last few years have been a fantastic learning experience, and if you're able to survive, significant corrections, we just had one this year in 2025, a very steep correction, and when you kind of build up rules by studying history, it can really help you going forward and to gain that knowledge. I think the last few years have been a great learning experience, a great time to learn how to trade. There's been great opportunity, both in 2020 was a spectacular year. I nearly doubled my Roth IRA during that. That's a no margin retirement account. And then 2024 was fantastic as well. There are a lot of, AI driven names that put on fantastic moves. But along with the bull markets, you have to be able to sustain corrections. And this is where, talking with Ross Haber, who, again, is one of my co-founders at Traderline, has been very helpful. He's been trading for 30 plus years at this point, worked under William O'Neill. And, the emphasis so much is on risk management and on building a market cycle system, so you're able to identify when the trends are turning and escape the worst of those corrections and get back in. You're never going to get back in right at the bottom, but get back in on the first higher low, or as we reclaim moving averages, and participate during the majority of the uptrends. I think the last few years have been a really special time in the markets where it's thrown a lot at us. And if you've been able to survive that, you've kind of established a system that can weather quite a bit as well.
Yeah, that's very interesting that you say that, actually, because thinking back, Dr. Wish's course sounds a lot like the course that I was teaching at the City University in the early 90s. And it was exactly the same in the sense that it was over a period of time, very, very practical, following the markets. But what was different back then was that the markets didn't move quite as much. And so when you talked about the potential for a crash or, accelerated price action or whatever, or big moves in anything, a big move in a stock might be a stock going from £1 to £1.50, as opposed to, going from £150 to $1,000. I mean, the thought of a share going to $1,000 in those times was, if you understand technical analysis, that's possible, but it was so outside the realm of the volatility that we were seeing, if that makes sense. And the only big event that had happened before that was the crash of 1987, and that was obviously huge for the time. Looks like a blip on the chart now, but it reversed out very quickly. And it's really nice to hear the names that you've mentioned, the market wizards. Linda Raschke, who was actually Linda Bradford Raschke when I remember reading her book, or reading her in Market Wizards. I've always found that her approach was closest perhaps to mine, in the sense that she's a pure chartist, just looks at the price, not even using anything other than moving averages. Even those are secondary. It's just looking at the price and what the price tells you, what the price patterns are showing you. And that is something that can only be done going back to experience through looking at lots of charts, which I can tell is something that you really do understand, because in your book near the end you put the charts worth studying, and because you put those up, it shows that you want people to get experience with looking at charts when they're reading your book.
Yeah, 100%. And that's kind of what I was talking about with regards to building a model book. The last chapter of the Trader's Handbook, I think there's over 200 plus annotated charts that I did looking back at the top stocks of the past 10 years or so. And like I said, there's been a lot of fantastic moves to study during that period. And by looking at those and learning how stocks correct, they form a low, they start to build the right-hand side of a base, they break out again and trend and form bases along the way. You'll learn kind of the blueprint of what a fantastic move looks like that you can participate in as a swing trader, as a day trader, as a position trader, as an active investor. And so we really wanted to include that chapter in there. The inspiration for that actually comes from How to Make Money in Stocks, William O'Neill's book, where at the very beginning, he pretty much does the same thing, bringing in a lot of weekly charts going back in history. And you mentioned, a fantastic move could be, £1 to £1.50. But actually going back in history, there's a lot of these amazing stocks that, go incredibly far. Priceline, Rocketdyne, whatever the innovation, the technical innovation that's going on in the world, whether it's rockets, whether it's the internet, the 90s featured many amazing moves. Charles Schwab is something that we opened the book with how Ross traded that back in the 90s. All these fantastic stocks, whatever the innovation is that's going on in the world, there's going to be companies out there that are benefiting from that and riding those tailwinds. And some of them can make spectacular moves. And we just have to study the blueprint of price and volume, as well as incorporating a little bit of fundamentals in there as well to help spot those that are growing the fastest in terms of earnings growth and sales growth. And we can apply that blueprint and hope to catch at least a few of them. We don't have to catch all of them. We're going to miss a lot. We're going to mishandle even more. But if you catch just one of those pretty well, on a 300% move or, even a few doubles, it could really move your account pretty dramatically. And each bull market kind of comes with its own cycle of these next true market leaders, is what we call them. Can Slim, the foundation that William O'Neill presented in his book, called them, true market leaders, model book stocks, all of that. So analyzing those charts is really important and something we definitely wanted to include because like you mentioned, we do have to actually experience trading to really get the most out of it. But studying the charts and learning how they move is probably the next best thing we can do.
Absolutely. I just wanted, before Tim jumps in with a question, I just wanted to ask about your definition. We've got a sophisticated audience, I'd like to think, and some who are very keen, but perhaps don't know all the phraseology. When
Sure.
you were talking about the different types of trader from swing to position, do you just want to define what you mean by that so that they understand where you're coming from?
For sure. So day trader, I would consider anyone who trades primarily intraday and is probably flat by the close and closing things out. So often they're trading based on catalysts that happen during the day or, enter at the open, close to open on maybe an opening range breakout, and are just selling, based on different signals intraday and are out by the close. Then kind of the next step up in terms of lengthening the time frame would be a swing trader. And I would consider a swing trader anybody who likes to hold for a few days to a few weeks. And I would put myself on the longer end of the swing trader spectrum. And then after that is what we call a position trader. And their goal is to hold weeks to months and really capture a larger move. But, they're not going to be as active as a swing trader or especially a day trader. Then after that on the spectrum, I would put an active investor where they're still making buy and sell decisions, potentially off the charts, maybe off weekly charts or monthly charts, but they're still incorporating technical analysis into their process. And then even more longer term than that is just an investor where it's more about dollar cost averaging and trading the company versus maybe trading the chart itself. So that's kind of the spectrum that, I defined for myself in my mind. And I would consider myself, like I mentioned, the longer end of swing trading or the shorter end of position trading. A lot of the time, the market almost dictates that, where if a lot of fast swings are being rewarded where breakouts aren't following through all the way, but maybe they go for a few days and then they turn around, I might lean a little bit more into swing trading, selling a little bit more into strength. But if there's a market like 2020 or 2024 where things are trending nicely above their moving averages, that's how I kind of define my trends for myself. I'm looking to hold until that trend really ends and the stock begins to start the next base. So yeah, that's kind of the spectrum that I define for myself. But yeah, happy to answer any follow up questions on that if hopefully that helps.
No, absolutely. No, that's really good. It's good to get people's definition because sometimes people use phrases, but they mean slightly different things by them. And when you're looking at position trader, you're not far off an investor at that point. There's a fine line between whether you're an investor or a position trader. Some would say it would depend whether the position's going right or wrong. There's an old joke about what's the difference between a trade and an investment. It depends whether it's gone right or wrong straight away. If it's gone wrong, in other words, they're going to hold it for a long time. And that's kind of like obviously the wrong thing to do. But it's, lots of the kind of humorous sayings in the markets are often very funny because they're very true. But Tim, you obviously you have an understanding of the technical analysis element because you're invested in trend following funds, which have price at its heart and obviously all the risk management that goes with it.
Yeah, I mean, the decision we took, and I've been allocating to trend following funds now for about 25 years, is that although it's not something we can do, it's not a skill set that's part of ours, it's something we value within a diversified portfolio, so we're quite happy to subcontract it out to others. I think that there's possibly an overlap at some point between trading, if you like, and investing, and there's a lot of sort of grey. There's, as Richard said, there's so many different ways and styles of putting money to work, hopefully successfully in the market, that there may be no end to them, and they may be almost infinite. But I think the thing that I keep coming back to is the idea that for whatever someone's doing, whatever process they implement should be on the basis of something that enables them to sleep well at night. In other words, if it feels comfortable, that's what you should be doing. And if it doesn't feel comfortable, you probably shouldn't be doing it.
Yeah, that makes sense. And it actually goes back to, I think, what you were saying earlier when you asked the question about can anybody be taught it? I mean, I would say, can anyone be taught value investing, Tim, do you think?
Again, it's because I think value investing is quite rare now. I suspect there's comparatively few genuine practitioners. A lot of people go under the guise of value, but the bottom line is that they're doing something I would suggest is something else, with momentum or growth or quality or whatever you want to call it. The trick is finding something that you can instinctively grasp and live with. And I think trying to do the wrong thing for you is just going to end in tears and disappointment.
Yeah, absolutely. I think it's actually very interesting that you say that, because I think within and Richard, I'd be really interested in what you think about this. Is you sometimes see what people think are technical patterns and setups that they've just got totally wrong, or they've got the wrong end of the money management side of it in a way that might appear to be right, but eventually it's going to go wrong, and therefore what they're saying is technical. There's a lot of people who say technical analysis just doesn't work, but they don't really understand it. And maybe they're using an oscillator and they're using it in the wrong way. And therefore, of course, it's not going to work because that's not what it's designed for. But if they haven't been taught correctly, they wouldn't know that. So you can understand why they would say, inverted commas, technical analysis doesn't work, because they're using something that they think is technical analysis that should tell them what to do, but it's not actually correct. You have to have other parameters. You have to understand lots of other things before you even go to use something like an oscillator. Would you agree with that?
Yeah, and I think it comes down to a misconception about what technical analysis is and how we use it. And for me and for pretty much all the market wizards who I've talked to, there's no real predictive ability. We're not trying to predict what's going to happen based on what a pattern shows, but we're trying to pick up evidence, pick up price and volume characteristics that have led us to strong trades in the past. And really what a setup is, and when we're trying to enter a stock, all a setup is basically a spot in the chart where we expect there can be a large directional move to the bullish side if we're looking to go long, to the bearish side if we're looking to go short, or use puts. And often what makes a great setup is actually, that it's very obvious if you're wrong at that point. So a breakout, there's a clear line of resistance where if the stock pushes above it, that's where you would go long. But if it then reverses back below that line, you quickly know that, the breakout didn't work. It failed. And the best breakouts just go and you're entering at a time where a lot of other individuals or institutions are piling in. And, you can use NVIDIA a few years ago. It had an amazing base near 500. And as soon as it broke out through resistance, it just didn't look back. It didn't even pull back to the 10 EMA really. So those are the best breakouts. And similarly with a pullback, if you're buying a pullback to support, what makes a great pullback setup is the support is very well defined. And if you're buying on strength off the support, if it reverses back below the moving average or horizontal level that you're watching, it's a clear indication that for that moment, potentially the trade has failed. And that doesn't mean that the stock has failed or the overall context of the chart is broken, but it could just be that particularly entry setup or entry tactic has failed at that moment. So really what I like to use technical analysis for is to identify these low risk spots where low risk means that very quickly within a few percent, if the stock doesn't do what I expect it to, I cut the position and either wait for another setup, another potential entry point, or move on to another opportunity, another stock. So I'm not using technical analysis to predict that this will definitely go up and double from this point. It will definitely go up 20% from this point. I'm looking to use it almost as more of a risk management tool to identify these key spots where the stock is matching the blueprint of what I've studied before in terms of my best winning trades, as well as just going back in history, the blueprint for these big winners. And it's a point where I can manage risk tightly and logically. So that logical part is, again, the clear level where the setup will have failed. And then the tight aspect there is within a few percent, my loss will be capped. My average loss is just over 3.2%. That's what it's been over the past year or so. And that's keeping it pretty tight. And I definitely get shaken out and the stock goes without me. But what that prevents is bigger losses that really significantly impact my portfolio. And it allows me the luxury of being wrong a lot of the time because, I'm wrong more often than I'm right with my trades. But how I incorporate things, because I'm a trend follower, is a winning trade I'm going to make a lot more than on average versus my losers. So I've built in a lot of failure, and my edge is more in my average gain to average loss ratio than it is needing to be right 75% of the time, 80% of the time, because I think there's a lot of emphasis on batting average and needing to be right all the time, but that's much more of an ego thing. In reality, a lot of the market wizards that I've talked to, they have pretty low batting averages, and their edge is much more on letting their best winners, do what they need to do, accept the asymmetry of the market and let it trend as much as it can until that ends, and keeping their losers, as little as possible so that they're taking paper cuts when they're wrong. And then when they're right, just one trade can pay for 3, 5, 10 losers. I think batting average is more affected by market conditions than the average gain and average loss. So that's why it can be very helpful to focus on that aspect of it. And I know I got off track from technical analysis, but I think the key point here for me is that technical analysis is more of a risk management tool to identify low risk entry points than it is anything that magically predicts based on, the MACD is at 60, the stochastic is at 20, and that magic combination is going to have a 95% win rate. That's great, but that's not the reality of trading really. And I think one thing that newer traders focus on too much early on is a little bit of these indicators and memorizing combinations versus trying to get a read on, what is the prevailing trend of the stock? What is the medium-term trend of the stock? What is the short-term trend of the stock? And aligning their actions with those trends versus, thinking very short term and say, all right, the MACD is under 10. When it pushes back up here, I'm going to buy because it's oversold. But, oversold in what context? If it's in a longer term downtrend and oversold, things can get a lot more oversold than even when they start to look oversold. So those are a few things that, I think about technical analysis. I think every indicator works, but you have to understand the situations which it works. And with that, definitely requires experience. And, I'm definitely a proponent of keeping things simple on your charts. My main indicators on my charts are price and volume action. And learning to read that and looking at structure, market structure, how price is building. I think having one or two indicators is fine, but when you have, 5 indicators like, stochastics, MACD, RSI, all this together, it's going to cause a lot of analysis paralysis because, your MACD might be saying it's a buy, but then the stochastic isn't saying that yet. So which one do you listen to? And I think people try to create certainty by having these black and white rules that with regards to indicators. But at the end of the day, these indicators are slightly lagging to price itself. And I want to keep my signals as close to price as itself because at the end of the day, that's how I get paid. I get paid based on price making movement from my entry price. And I protect myself if price reverses down below my entry price. And, price and volume action is the best way to keep my risk in check and identify the best entry points, at least for me. I've simplified my charts over the years. I started, like a lot of people, having a lot of indicators, but the more, I trade, the simpler my charts get. And having talked to a lot of these folks who have been trading for decades, Peter Brandt comes to mind. His charts are basically black bars and on a white background, and that's what he trades off of. And he just looks at these classical patterns, and he's built that intuition over the years. And I think that intuition does have to be built. You have to take the time to learn to read price action. But I think it's a lot more beneficial to focus on that versus trying to memorize different combinations. There's all those cheat sheets out there with doji candles and, reversals and all that. Yeah. And those work, but in context, right?
Yeah.
And
there's single bar patterns. That's the point.
Right.
Yeah.
Exactly. And the single bar is almost the least important part. Like I said, the trends are what's going to make you money. And there's a lot of almost there's a lot of volatility and randomness in maybe a single bar. Those are a few thoughts on technical analysis. And I think, again, I want to emphasize, I think an indicator can work, a MACD, RSI, but you almost have to specialize in one of those and learn the situations where it works, learn the context, the markets, the type of market that it works in. And, I think the biggest point is think of the larger context and don't just become too focused on any one signal, any one indicator, and just trust that blindly. Always think of the larger context. I think that's really, really key.
Do you focus on specific markets, or do you happy to trade anything? So equities, interest rates, currencies?
I'm just equities, just stocks, just the U.S. markets, yeah, and ETFs as well. ETFs of different groups and that type of thing. You can, if I've identified a lot of semiconductor names that are setting up together, I'll look to trade SOXL or just the Nasdaq 100 leverage ETF TQQQ can be a really good swing trade instrument that I like to build a position at the start of a market cycle, start of an uptrend for me. And, that can be a fantastic way to get exposure quickly. And you can either just ride that and as long as the trend holds, hold that, or sell that and then finance positions in individual stocks that then show up during a new market cycle. So yeah, equity focus for me. And that's primarily what I've been focused on.
And then in the context of an equity trade, will you put something put a position on the basis of a price action or on the basis potentially of a quote narrative unquote?
Yeah, so price action is the most important at the end of the day. However, I think something I've been focusing on more over the past year or so is focusing on stocks that have catalysts behind them and are part of an overall theme that has a reason to generally make a significant move. Coinbase is a good recent example. COIN for everybody. That's the ticker symbol. It set up a really nice pattern after a gap up. I think it was included in. I think there was some news around it, but basically it set up a nice consolidation after a gap up. So the technical characteristics are it's in an uptrend. It had a recent gap up, which is a show of strength, and then it consolidated nicely, formed a nice tight area, reclaimed the 21 EMA, and then set up a nice inside day below a larger time frame pivot.
Richard, hold on.
Sure. There's a lot of words there. Yeah, sorry.
I understand everything you're saying, but that's not actually fair on people who don't know technicals. For sure. Yeah. So to put it in layman's language, basically the market moved up and it sort of compressed, came back for a little pullback, and now it's just kind of shot up. That's what you're saying, right?
For sure. Yeah. Consolidation is just a compression where a stock oscillates above and below a certain range and gets tighter. And that's definitely a key thing that I look for. And I'm looking to buy the breakout from that tightness. And basically how that combines with the question you asked before is that breakout coincided with a positive news catalyst around Coinbase where they'd be able to trade tokens. I forget the exact thing. I don't actually care about the catalyst itself. I care about the price reaction to the catalyst. And it was very positive. It broke out and I had a nice swing trade on this, sold into strength as it trended higher. But that's kind of what I'm looking for. I'm looking for a strong stock that has momentum, that's trending above the moving averages, contracting in volatility and forming one of those compressions, and then looking to start a position as it breaks out of that contraction. That's, if to sum up my style, that's pretty much it to a T.
Is there a particular reason why you would limit I say limit, there isn't really much of a limit when you're looking at stocks, but why do you focus just on stocks and say, for example, silver did something like that very recently, and silver miners and the way that they compressed and then broke out? Are you just trying to cut down on all the markets that you look at, or is there a particular reason why you might avoid looking at, say, precious metals or something else?
I think there's enough really good moves in equities that there's enough to trade there from my perspective. And the more you're trying to watch everything, the less actually you end up catching. So stocks for me has kind of always been my focus. That's how I was trained, really. But I don't see a reason to really focus on anything else because there's been just so much potential in the equities market. A kind of follow-on question to that is, why don't I trade options in addition to actual shares, which is what I trade? And the reason for that is it just kind of complicates things. You have to be right both on the direction of the trend as well as the timing of that trend. And it just adds a layer of complication that, I want to strip away. I want to keep things as simple as possible and just focus on the price and volume action of the stock itself. I'm definitely open in the future to evolving as a trader, learning new methods, all of that. But for me, the focus right now is just on equities, just to simplify things and become an expert in that domain. And then, after that, I can evolve, add new markets, add new tools to my toolkit and all of that. But yeah, just for right now, my focus is on stocks and specifically trading shares of stocks. So
while we were speaking, I popped to find a book that I got many years ago, all the way back in 1994, if you can believe that. It's a book which I think you might have mentioned. Was it a book by Tony Crable? I've got his Day Trading with Short-Term Price Patterns and Opening Range Breakout, because you mentioned Opening Range Breakout. So I wonder whether you'd heard of that book.
I haven't specifically. I've talked with a lot of traders who have probably, read that, or, the opening range breakout concept. I don't know who developed it or
I think it was him. Yeah. It was basically him. Yeah.
Well, it's fantastic. It's a great way to manage risk on an intraday time frame. And I like to use it when it coincides with a setup on a daily or weekly time frame. I only really look at intraday patterns when the stock is potentially ready for a move based on the higher time frames, if that makes sense. But the opening range breakout is a great way to manage risk. For instance, if there's a great setup is the gapper setup. We talked about this in the Trader's Handbook. And the gapper setup is basically, it's self-explanatory almost. It's when the stock makes a significant gap up in price often coinciding with a catalyst like an earnings report or a significant news event, a new product or service that they're launching, a change in CEO that can cause a gap up. But probably the most common is on an earnings report. And the opening range breakout is a way to manage risk and trade that first gap up day. And, often, sometimes stocks make a 10, 20, even more percent move on that first day. And the opening range breakout is a way to manage risk and enter. And if it trends nicely, you're along for the ride. And if it reverses off that opening range breakout and fails that breakout, you're out with, again, a small loss. And that's the name of the game, to potentially be in a trend that goes nicely in multiple risk multiples. But if the trade goes against you, be out and manage risk, and the opening range breakout is a great way to do that.
So with regard to looking at your chapters of your book, edges and setups, that is one that sort of jumps out at me, which I think people would be really interested in. Could you talk a little bit? Of course, the edge is what everybody wants to have and understand. Tell us about edges and setups.
Yeah, this is the sexy part of trading, edges and setups. So in this chapter and each of the chapters, we talk about the concept as a whole. So what is an edge? What is a setup? But then we talk about the ones that we specifically use. So an edge for me, and I've kind of talked about this without actually saying the word edge, an edge is nothing more than a series of price and volume characteristics that point to that a stock might be a big winner in the near future. So I've mentioned gap ups. That's something I look for. I've mentioned relative strength. So performing well when the overall market isn't performing well. That's a suggestion to us that the big institutions, which are the ones that really create the trends in the market, are supporting that name and even buying more when the overall market is pulling in. And those are names that we want to be focused on. And a really good example of this here in 2025 is we had a recent pretty significant correction. But if you bring up a chart of Robinhood or Palantir, all these names did correct pretty hard. But a sign of relative strength was that they held above the 200-day moving average. They formed a base, a consolidation, a contraction above that key moving average when the market itself just sliced through that and went well below. Most stocks in the market as well fell significantly below their 200 moving average. So the fact that these names that now have risen quite a bit and have been trending for months really held above the 200-day moving average was one of the edges and signs of relative strength that I was looking for to basically be focused on these names because they're showing potential. And that's basically what an edge is we're looking for signs that a stock is showing potential. So relative strength is a big one that we talk about in the book. Another key thing that I talk about, that we talk about in the book, which is a little bit more fundamental focused, is the N factor edge. And the N factor edge just basically comes from, again, our foundation is how to make money in stocks. There's basically the acronym CAN-SLIM, which describes the characteristics to look for in a big stock. And the N in CAN-SLIM stands for new. So this could be a new product, new service, new CEO, new price high, something new that's happening with the stock. And this N factor, which is what we talk about in the book, is basically, what sets this company, this stock apart from everything else in the market? What sets it apart from its peers? And we're always trying to think about what stocks have the best product, what stocks are growing the fastest because of that product. And a really good example of the N factor edge and how something new about a company can change a stock is, and we use this in the book, is Netflix. If you bring up Netflix on a very longer term time frame, there's been very significant corrections in Netflix, 70, 80%. And along the way, after those corrections, there's been amazing moves of several hundreds of percent. But what's created and caused those big moves in the stock on a company level? And what's caused it is they've continued to evolve as a company. The first N factor edge is the transition away from DVDs to online streaming. That caused a big move in the stock. There was a transition from just US based to international. That caused that N factor caused a nice move. There's the transition, and this is probably the biggest one that is most famous, is the development of original, media. The House of Cards, I think, was the first one. And if you actually think about when House of Cards came out, I think it was in 2013 or so, that preceded the dramatic move expansion in the stock's price action. So these are type of catalysts and factors that we're looking for to think about, what is the narrative around the stock? What's going to drive the stock to go up several 100% over the course of years? Maybe it doesn't happen in a week. Most of them don't. But what's going to contribute to institutions wanting to build positions and add to positions in the stock, and new stuff that's going to drive future earnings and sales growth is what we're looking for. And that's what we talk about in terms of the end factor edge. I think recently, and Netflix is a great example because they continue to do this. They've started to experiment with games and live streaming events. And, all this stuff is kind of what we look for. And all this is a potential. An edge doesn't mean that it's 100% going to be a big winner. But what it means is that there's something special about the company to make it warrant a second look, and to look closer at the price action, see if there's a setup there, see if there's other edges at play. This is more of a fundamental edge. Is there also big signs of accumulation, like huge volume bars and large gap ups on volume that suggest that there's more significant accumulation going on? But those are a few examples of edges. And they're nothing revolutionary. They're just something that we like to point out to pay attention a little bit more. A-Lab is another good example of an edge last year. This was one of my best trades of 2024. A-Lab, I think they create these special wiring connections that's used in AI databases to boost basically performance. And a big edge that we look for in a recent IPO, because this was a name that came public in 2024 actually, is we look for an increase in average volume, basically increase in signs of liquidity in the stock. And that occurred right near the bottom, the turn. A lot of IPOs, they come out public. They're a disappointment at first, they correct. And often at the bottom of that correction, what we're looking for is an increase in average volume, suggesting that institutions are becoming interested in the name. They're researching the name. They're starting to build positions in it. And that accumulation will show up in the price and volume action. And as early as August of 2024, we started to see an increase in average volume of the stock. You can measure this by basically plotting a moving average on your volume and just seeing, is that line increasing over time? And when you start to see an increase in average volume, when it coincides with other edges, other setups, all of that, it's a good time to pay attention and potentially look deeper into that stock and consider it for a potential trade or investment. I think those are three of the key ones. And we talk a little bit more in the book. Some of them are a little bit nuanced, looking for gaps that don't get filled. We're basically at the end of the day looking for a sign of institutional bid and institutional interest, and that will show up based on it will show up in big moves in the stock's price chart. Gap ups on volume, breakouts on volume, and it will also show up, elsewhere, in a more fundamental nature, looking for big earnings and sales growth. And then, like I mentioned, the end factor edge. What sets the stock apart? Robinhood's been a really big name recently. What sets it apart? Well, it basically is appealing to the younger generation, enabling them to get more control of their investments. They're launching new products, and all that end factor contributes to the potential for future strong earnings growth or sales growth, which is what institutions care about at the end of the day. And speaking of institutions, another edge that we look for is simply an increase in the number of institutions that are buying the stock and have positions. And we have a data in DeepView itself where we track the number of funds that are invested in a company on a quarterly basis when they report it. And one edge that we look for is an increase in fund ownership over time, because like I mentioned, institutions and big funds and big institutions, those are really what drive stocks over time. And to use Palantir as an example, Palantir obviously over the past 3 years now has gained over 1,000%. And if we go back and look at the fund ownership, since June 2023, it had a little bit over 1,000 funds invested, and now it's got over 2,500 funds invested. And that's what's created this trend, is that more and more institutions are buying the stock. So a big edge that we look for is in the number of funds that are owning it, the overall ownership as well. We want to see that number increasing steadily after quarter. That just helps give us a little bit more conviction that the stock might be worth, focusing on for a trend and looking for a spot in that trend to jump on along for the ride, maybe using a shorter term pullback as an entry, and then looking to jump on that longer term trend that we see on the weekly or monthly chart. And I know I just said a lot of stuff there, so please let me know if there's any follow-up questions or you'd like me to dive deeper into any of those specific edges.
What I think is interesting about Netflix as an example is, in simple technical analysis terms, when it broke its all-time high at $700, it moved up to $1,300, which is where it is now. And
Yep.
For me, it's just that's what I look for. I just look for the chart, and I keep it relatively simple. But what I found fascinating about Netflix is, I think a lot of people who are, dare I say it, like Tim and myself, slightly longer in the tooth, who saw that transition in real time from VHS video to DVDs being sent to you day to day, and then Netflix appearing and people going, oh, that's never going to catch on, and actually becoming one of the biggest platforms in the world, was that Netflix actually, behind everything, were using AI. And I didn't realize that at the time, but they've been using AI since
forever.
2000. Yeah, 2006. They were using something called Cinematch to work out viewer engagement, which I thought showed amazing vision and was far more than just a transition from one product to another. It really showed that they were looking at the future and how they could leverage technology to their advantage. Now, I also think that there's an element of saturation, and this is possibly why they're looking at other revenue streams, because it's a competitive market out there. And at some point, you're going to reach as a viewer, as a consumer, you've got Paramount Plus, you've got Amazon Prime, you've got your main TV channels, and then you've got Netflix, and then you've got all the subcategories as well that you can subscribe to. The competition is fierce, so you really have to stay ahead of the game or start eating up the competition. Now, I'm putting my fundamental hat on, which is not really my forte. It's just an observation, and it is all still down to the chart. But I just thought that was particularly interesting about the Netflix example.
Yeah, I completely agree. I'm a mechanical engineer by major, by training, and I actually studied machine learning a little bit in grad school.
Oh, cool.
And they actually put out, they had like a contest that helped create that algorithm in the first place, where I think they reached out and tried to build the best recommendation algorithm, and anybody who could beat them, they gave a reward. So yeah, I think it's such a cool story. And Netflix right now, I consider much more of a mature stock, and we're looking a little bit more. I personally like to look more for a little bit of the newer companies that could evolve into a Netflix, if that makes sense. They have that potential, and that's often where the biggest price expansion, price trends happen, is when a stock comes to market and goes through, a correction phase, and then kind of proves itself. It proves to be profitable. Its first products, show promise. And that trend right there, that first trend, is often the best one. Netflix is a little bit of the exception, where it's had multiple model book moves, multiple amazing trends driven by those transitions in the business. I think Netflix is a really fascinating case study, and you can learn a lot just by studying, Netflix's chart and Netflix's story. And another stock that I think is just fascinating to study is Tesla and its transitions as well. The 2019-2020 move that really got it into everybody's minds was driven because it showed the first signs of profitability. And the big question around Tesla at that time, it had been basing pretty much for years and years, is can they actually turn a profit? Can they actually grow this? And what created that amazing move in 2019, if you look back on your charts, is there's a big gap up in the fall of 2019. That was after an earnings report where they basically said, factories are ahead of schedule. We're going to be profitable, all that. And that answered the key question that institutions were looking for and led to that amazing move. So Yeah, I'm a chartist. I use technical analysis to identify trends, to manage risk, all of that. But considering the reasons behind a move, the catalyst, that's an additional edge on top. That's an additional layer where I don't want to get too in the weeds of trying to run spreadsheets and see what's the margin going to be on this, predicting it 5 quarters out in the future. But if a stock is showing substantial new innovations, new patterns like that, strong earnings growth, all of that, that gets me more focused on the chart and looking for those technical analysis edges, like big gap ups on volume. Because in the Tesla example, that gap up on let me actually get the actual date here for you. The gap up, so people can follow along on their own charts. That gap up occurred way back in October 24th was the big gap up. And then we followed through the next day even more. And those 2 days were on the highest volume in over a year. The first day, the first gap up was the highest volume, and then the next day even exceeded that. And what does that tell me? That tells me that institutions are scrambling over each other to accumulate shares, build positions, because they see a shift in the future possibilities of Tesla. So that is another edge actually worth mentioning. The highest volume edge, the highest volume in a year, the highest volume ever. That's a key one as well. Those are volume signatures that we look for, and then we investigate to see, is there a setup? Is there something more going on with the company? What was the catalyst that created that big burst in momentum? Because often these days we see big volume, sometimes based on an index rebalancing or something like that, and we discount that. We're looking for big volume associated with a catalyst that's potentially game changing with regards to future earnings or sales growth. And, there's a lot of ones that happen on earnings. It can be a new product announcement that can be key as well. But yeah, I think the volume signature is really key. And I'm off on a new train of thought here. But yeah, I think Netflix is great to study. I think Tesla is a really great stock to study as well, both the price and volume action as well as the fundamental aspects. So sorry for going on a little bit of a rant there, but
that's
yeah.
fine. That's fine. I was just thinking while you were speaking that what we have here is a kind of an inverse situation in terms of how much research is done on the fundamentals before an investment is made between you and Tim. And I was just wondering, Tim, how long does it take you, or how much research do you do before you actually invest in a company on the other side of this?
It's probably a matter of weeks rather than just days. So it'll be a combination of balance sheet analysis and then after that technical analysis. So we take quite a few subscriptions to technical analysis firms now to help our process. But in terms of the hard work, the spade work, if you like, it's probably a few weeks.
Because you can't really dig that detail out of a chart. You have to.
Sure, because I mean, we use, for example, the fundamental analysis screen, the FA screen on Bloomberg, to get to the sort of the data that matters. Things like margins, price to book, all the other sort of the classic sort of Ben Graham characteristics. But so technology certainly makes it easier to screen, and I know my colleagues are using AI to sort of help the process as well, because AI is just so efficient it's like sort of hyper efficient sort of search engine.
Absolutely, yeah.
So there's I mean, it's amazing the way the business is changing in such a fast way. And I'd be interested in Richard's thoughts actually about how this presumed market efficiency is going to change trading opportunities or potentially affect trading opportunities. Because I would have thought that with the computing power that's now being put to work, logically that would smooth out trading opportunities per se. Is that a fair assumption?
Yeah, I think it'll impact it, but I'd actually ask a question to you. Obviously, depending on the fund size, it takes time to accumulate a position. So, for you, if there's an idea that you, as a fund, as a firm, are really focused on and think will make a change, how long does it take for you guys to accumulate the shares you want, and how often will you go and add in the future if the thesis that you have from a fundamental nature kind of comes to light and continues to develop? So how long does it? Yeah, go ahead, please.
It's a good question, because the way we operate, because we're basically discretionary private client managers, and we're obligated to basically conform to the regulatory standards from the FCA here in the UK. there's a thing called treating customers fairly, for example, a principle called treating customers fairly. So basically, where one client goes, all clients must go. So you can't discriminate between clients. So that means everyone has to basically own pretty much the same thing bought at the same price and at the same time.
Wow. How do you do that then?
So, well, as a result of that, what it means is, for example, we have certain criteria whereby there are certain stocks we may never hold because then they're just not liquid enough for us, or if it would take time to put on a position, it'll adversely affect the later purchases rather than the earlier ones. So, for that reason, we've got certain criteria that we can't really compromise on, and one of them is liquidity.
Yeah, and that kind of goes to some of the edges that we talked about, the increasing average volume at the lows after an IPO correction. That's the liquidity necessary for bigger institutions to, build positions for their clients. So that kind of is the reason behind why the edge works. And Tim, I don't know if you actually answered the question, but might it take you days or weeks to establish a position if it meets your liquidity requirements and all that?
Oh, it could plausibly. I mean, ideally, we'd like to do it. We'd like to do it sooner rather than later. So we'd prefer just to get something in and out in one clip. But realistically, particularly if it's just a smaller cap stock, then we're resigned to the fact that it may take a bit of time to initiate the full position.
So this creates the trends that we're talking about, and what we like to capitalize on is funds like yours. And it's not just going to be your fund looking to invest in the next great company, whatever it is, AI related or semiconductor related, all of that. And all these different funds are needing to accumulate their positions over days, weeks, and sometimes months. They might add more on the next earnings report as they continue to see progress. So all this accumulation is, drying up the supply. The increased demand drives the stock price higher, and it creates the trends that we're looking to capitalize on as traders. So to answer, this is kind of a circuitous way of answering your question. The increased efficiency, I think, won't change that fact that when there's a new and amazing company that all growth funds of a similar objective are looking to accumulate shares in, they're going to need to fight each other for those shares, accumulate it over time, and that accumulation is going to create trends that we can capitalize on as traders. So I think the increased use of AI, increased efficiency, it might affect a lot of short-term moves and make them faster. We've already seen that. This recent correction in the U.S. stock market was incredibly fast. We saw responses to the president's tweets that moved the market, 20%, almost 20% in one day, talking about the tariffs. So all that stuff in the very short term is very, ripe for AI causing big moves. But the main trends that I'm looking to trade, and kind of my foundational styles way of trading, is to identify the stocks that are going to change how we work, live, and play, have a meaningful impact on our society, grow their earnings or sales incredibly fast. These are the type of companies that funds like yours are looking to accumulate because you believe in a vision, 3 years down the road, 5 years down the road. You have a lot longer of a time frame. Funds have a lot longer of a time frame than ours, but because they're building positions and adding to those positions, they're drying up the supply, increasing the demand, and pushing the stock price higher. And those are the trends that we're really looking to catch. So I'm not sure if I exactly answer your question. Please feel free to rephrase it.
No, that's absolutely fine. Yeah. That's absolutely fine. Yeah. Thank you.
Yeah, cool. That makes perfect sense. With regard to the size of the company then, because what I was thinking about while you were talking about smaller companies, I was kind of envisaging, say, an S&P 1500 company sort of working its way up into maybe an S&P 500 company. Mm-hmm. Or are you looking at sort of smaller than that and sort of very IPOs and NASDAQ stocks?
Yeah, so I would say I'm looking probably for a market cap size of 5 billion plus.
Oh, okay.
And probably focusing more 10 billion plus. I'm trying to look for a company that has proven itself. I don't want to be trading a tiny small cap, like 200 million market cap. I don't want to trade that. I want it to have proven itself enough that it's already established, but it has a lot of potential growth ahead of it. So trading a stock from CrowdStrike is a name that now, let me actually look at what the market cap is. It's about 120 billion. But, I was trading this back closer to its IPO when it might have been, a $20 billion company and trying to find that, capture that growth from the $20 billion to $100 billion or $5 billion to $15 billion. So, yeah, does that kind of answer your question? I don't want too small, but I want a stock that still has room to grow, right? I don't, an Apple right now, it's a slower mover, but it's not going to double in 5 months, right?
Yeah.
So there's kind of a trade-off there where I want an established size company, but one that has potential to make a nice move during a market cycle uptrend.
Yeah, absolutely. No, it makes perfect sense. I was just wondering though, not necessarily for taking a trade, but actually putting it on your radar that that it's something that is kind of coming into your radar, some of those smaller stocks. So I just wanted, there's always this temptation to kind of say, oh, I want to look at what's moving into the zone that you're currently studying now, what the ones moving up into that zone, and then obviously you want them to move out of that zone and higher. So I was just wondering how far you would cast the net. And as Tim was saying, with AI and technology, it gives you the capability to do far more and to look at far more markets than one could have done a few years ago. So you may not be disadvantaged, but I'm kind of remembering a little bit of what you said earlier on about if you look at too many markets, it can kind of muddy the picture. So you're obviously quite happy with where you're placed.
Yeah, I'd say on most of my screens in DeepView, which I use to screen, I'm probably setting a minimum market cap of 1 billion, I would say. That's kind of the base criteria. And for certain screens that might be more looking for really large momentum movers, because those often are a little bit smaller, I might not have a market cap criteria. For instance, I have a big gap on volume screen that just looks for, a really big move on large volume. And this can be good to capture more catalyst type trading opportunities that are much more faster in nature. And for instance, this particular screen picked up, I don't know if you guys are familiar with ASTS, but it's basically a satellite company. And last year in May 2024, it basically founded agreements with Verizon, AT&T to basically, carry their networks. And this created a really large move. I caught a tiny piece of it. I didn't trade it very well, but it was a fantastic move to study. And it was much more catalyst driven. And if you had, we're only looking at your screens that focus on market cap above $1 billion. I don't actually know what the market cap was when it got started, but it was smaller than my typical range for sure. But I also like to look at those more momentum mover type screens that might not have that market cap criteria, because a lot of the catalyst driven trends that we see happen in those smaller caps. And ASTS, again, I didn't trade this particularly well, but it had a fantastic move, a lot of trading opportunities from the earnings gaps, catalyst announcements, high type flag setups. And I think this made a 1,000% move in a matter of a few months. Again, I didn't trade this well, but I think it's a good case study to look at. But it's an example of a stock that you might miss out if you only look at screens that filter out by market cap. So I have I probably have 3 to 5 main screens I look through, and probably look through maybe 300 to 500 charts a day, but just space barring through very quickly, looking for pattern recognition, see if anything stands out. I'm not spending 5 minutes on a chart unless something piques my interest and says, hey, look more closely at this name. I'm pretty much going pretty fast through these, space barring through all the different charts. We also have a mode which allows you to look at basically scroll through 9 charts at once, so you can really kind of speed up your routine. Again, we're all about doing that for DeepView. So I forget exactly the question I was answering. I'm so sorry.
You were talking about exactly what I was saying, which is
cool.
Looking at smaller cap stocks going into the radar, which is, I'm just looking at your AST Space Mobile chart.
Yeah.
And from what I can see, for viewers, obviously, who haven't got this chart in front of them, or listeners, I should say, it was basically in a downward channel trend that started around $23 or so, and it traded all the way down to $1.98 as a low in April 2024, and then just suddenly shot up in a way that, you know, it was changing its market dynamics. But I think the buy point, if I was being honest from a technical point of view, wouldn't have come in from at least $5 and then maybe actually over $9. And that's a huge percentage move already. But then from that $9 move, it went up very fast to $38 and then consolidated from August to June, so August 24 to June 25, and is now just broken out over $33, and it's trading at $51. So it's had what I would say two phases where you would reasonably be looking to buy it. Otherwise, I think there wouldn't be any technical justification for getting in. Would you agree with that?
Yeah, for sure. And one thing I want to point out with this chart is you're absolutely right. You know, there's buy points around $9, $10, $11 around there. But this featured that edge I was talking about previously, where it's the highest volume ever. And what the highest volume ever edge really shows is something game changing is happening, and you want to look into that catalyst. And for this stock individually, it was a big partnership with AT&T and Verizon, which again, we're looking for catalysts that are going to drive future earnings and sales growth, and partnerships with large telecom companies is exactly that. So that would have gotten it on your radar a little bit sooner. But then, yeah, it's all about after you've identified stock that has potential, has edges, what is the setup and what is the entry tactic that you're going to use to enter position and manage risk as you're doing so? And that might not be until later on. I think I actually traded the high type flag setup around $14 and got a nice piece of it. There's a breakout there. But yeah, there's other traders who I've talked to who killed this and traded more the post-range breakout, the post-gap range breakout. So after that initial gap up in May 16th, it moved up for a few days, then pulled back to the 10-day EMA, the moving average, around and consolidated around $4, and then moved up again. So that would be kind of the first higher low type setup where you could enter. But because it's such a strong stock, there were a couple entry points along the way. And I think another thing that's worth pointing out with ASTS is that it was part of kind of a theme last year where RKLB, Rocket Lab, was another rocket ship type stock, so in that same theme, and it also had a really nice trend and opportunity. I traded this one as well, and this one has a breakout around $6, and then a few other compressions, contractions that were actionable after that, before it actually kind of broke its all-time high about $21 and change. So I'm always looking for, and you rightly pointed out that ASTS was consolidating, pulling back in a downtrend really for years until we saw that highest volume edge, which is what gets it on our radar. And Rocket Lab similarly had done really nothing from 2022 until it started an uptrend and broke above the moving averages in 2024. So I don't know my exact point here, but we're always looking for sister stocks, ASTS, RKLB, same type of theme, and then the price and volume action is what gets us interested on top of that, and sometimes actually points us to the theme. If I see a lot of semiconductors gapping up on volume, hey, there might be something going on that's contributing to the semiconductor space that I should look deeper into. So I always like to trade. This goes back to Stan Weinstein. Focusing on the leading stocks and leading groups. Both Stan and William O'Neill emphasize that. It's always good when there's sister stocks acting well. It gives you a little bit more confidence that that stock is riding the tailwind that's impacting all the stocks in that particular group or theme.
No, that's great. War stories and actual trades I really like, because of course it's the most honest thing. It's the things that you've actually taken and the trades that you've put on that you really believe. With regard to the macro picture, do you look at any economic data at all, or do you look at any say, base metals, precious metals, just for the macro scene rather than actual trades in those markets? Obviously, you don't trade those markets, but does that help you create a picture of what the economy's doing, bond markets, etc.?
I don't really. I pay attention to what the Fed is saying, and even more important, that the market reaction to Fed announcements, whether that's a speech from Powell or an interest rate hike or cut announcement. But I don't really delve deeper than that. For me, the stocks kind of show what's going on with regards to how the market's interpreting the macro picture. If you go back to this year as a good example and bring up the QQQ, it started a downtrend, broke below the 21 EMA in February of 2025. And that's when I pretty much exited any longs I had. And that was before the tariff stuff happened. That was before, the macro picture got a little bit more bleak and more severe. And I guess in short, I don't really consider the news, but I consider the price's reaction, the market's reaction to those news events, and how that creates trends and develops trends in the indexes and then also the individual stocks themselves.
So let's say someone's got $100,000 and they see a trade that they want to take. So we like the look of X. How much should they put on that trade? How should they manage it?
Yeah, it's going to be up to each person's risk tolerance. I kind of set my position size by looking at how much I want to risk of my total portfolio. And it's actually, I'm decreasing it a little bit. It used to be about 0.6% of my total portfolio. But now I'm trying to get it under 0.5. And so basically what I'll do is I'll have that amount that I want to risk in my portfolio. And in a strong market, that's going to be, again, 0.5%. In a market that's in a correction or choppy or recent trades of mine haven't done well, I'm going to maybe have that and do 0.25% of my portfolio. And then I'm going to calculate the dollar amounts that is of my portfolio and divide look at basically the setup. Where would I place my stop loss? What's my anticipated loss? And then do that calculation to match up the position size I'll set with how much I am willing to risk and lose of my portfolio. So if 100K, probably, I'm risking on average, like I said, a little bit over 3%, on a position.
You said 0.6. You said 0.6%.
Yeah.
Sorry.
Yeah. 0.6% of my portfolio.
Okay.
And probably about 3% stop loss on average on a position.
Okay.
So yeah.
3% stop loss. Right. Okay. Right. No, that's interesting. And you talked about the interviews that you had with the market wizards, like lots of them, and obviously you got some who are working with you. What have you compiled these interviews? I mean, could there be a book there on top of the book that you've made?
Yeah, it's something I'm considering. A book is a big endeavor, as we realized over the past year plus. But it would be something I would have a lot of fun with, because I think all the interviews I've done are available for free on YouTube, which is awesome. So, it's available in that medium, but I think it'd be really cool to dive a little bit deeper, put together a book of my favorite ones, the most impactful ones for me, key takeaways. So I think that would be a lot of fun. But maybe a future project. Nothing set in stone for now. Right.
Okay. No, it's. I mean, I grew up on the Market Wizards, and the Market Wizards, new Market Wizards. Absolutely love Jack Schwager books.
He's fantastic.
Yeah,
and he's a big influence of mine. And Jack will actually be a guest at. We're doing a free online trading conference this year. Jack will be speaking. I'll be asking him questions about key takeaways from Market Wizards. But yeah, Jack is fantastic. The Market Wizards. You can't see me right now, but it's right behind me on my bookshelf. Hats off to him. And there's so many great takeaways from those books, risk management, all of that. So yeah, I think a book, there's no plan set in stone right now, but a book similar to that, compiling some of the interviews I've done in the video medium, which is available on YouTube, could be a lot of very cool to go deeper into those topics and all that. That would be a lot of fun.
What I really love about a lot of I haven't met all the wizards, but all the ones that I've seen interviewed and the people that are involved is that they are just very humble, really nice people. You know, they're not arrogant. They're confident, but not arrogant. And people, there is a big difference between those two traits. You know, you can be confident in what you're doing, but you don't have to be rude or arrogant. And they aren't. They're just the nicest people, and they love talking about markets.
Yeah, I completely agree. It's been amazing. So when I started in 2019, let's see, I was 20 years old or 21 years old, and I would reach out via email, via Twitter DM to these guys who have been in the business for 30 plus years, and they're willing to answer my questions, spend time, walk through charts, and I'd echo exactly what you said. And I think the market humbles you. The longer you're in this, you know that you never know what's going to happen, and the setup that you think is going to be the best trade ends up being your biggest loser or something like that. So I think. I think it's a trait that market wizards share for a reason. Is they understand that the market can throw anything at them, and they have to be ready. They have to manage risk above all else. I'd echo all the market wizards that I've gotten a chance to talk to. Incredibly helpful and willing to help out anybody, because this is a tough business, and if they can share some of their wisdom and thoughts, they're absolutely willing to do so. So that's been fantastic.
Brilliant. Now, Tim, you wrote a book a long while ago. Actually, you've written a couple of books, haven't you? The War on Cash and Investing Through the Looking Glass. Do you ever get the urge to write another one?
Never.
Right. You sure you don't want to have a think about that?
No, there's nothing left to be said.
Right.
No. What's the Mungerism? Nothing to add.
Nothing to add. So, with regard to that, were there any questions, Tim, that you wanted to ask Richard?
I guess what I would conclude with would be what's your take on sort of just like the tone of the market and the sort of macro environment more generally. The reason I'll frame that with my bias, which I think we're living through the tail end of a monetary system. So I think that there is going to be monetary system regime change in the months to come.
Yeah, I think my thought on it, obviously my time frame's a little bit shorter than yours. We just hit new highs on the QQQ, the NASDAQ. We've been in an uptrend since around April 23, 24 as we reclaim that moving average. So in the short term, we're in an uptrend, and I keep it as short term as that. In terms of monetary policy, maybe. But I'll react to that when it happens. If we begin a larger correction, all of that. From my point of view, stocks are acting well. They're in uptrends for the time being. That could change at any time. But for right now, my simple view at a very simple basis is we're in an uptrend above the moving averages. So once that changes from a technical perspective, I'll change my view as well.
Change as well. Yes.
Exactly. Yeah.
With regard to questions that we've asked you, Richard, was there anything that you wanted to mention that we didn't ask you that you'd like to talk about?
No, I think that pretty much covers what I had wrote down here. I put down some key lessons from talking with market wizards, but I touched on most of those already. Yeah. So I think we're good from my side.
Okay, brilliant. So should we go to media picks then, Tim?
Go for it. Okay.
Could you go first? Would that be all right?
Sure. So this is something I saw yesterday. It's a film documentary I saw for free on YouTube, which hopefully will still be hosting it. It's called The Agenda, Their Vision, Your Future. It's only just come out by Oracle Films in the UK. And it's the most comprehensive account of why the world has seemingly gone mad over the last 5 years. And it names names, and it names the organizations responsible. And there's some usual suspects who are given an airing in terms of talking heads, one of which is someone we've happily had on the show, which is Nick Hudson of Pandata. Catherine Austin Fitz is also there. It's called The Agenda. It's just shy of 2 hours long. It's gripping. It's very well done. It's fully comprehensive. It touches on just about everything that's happened, including COVID, the push to CBDC, digital ID, none of the works. It's very comprehensive. Watch it, and if you like it, then share with your friends, because this message needs to get out there. We are being systematically plundered on behalf of a predator class that needs to be destroyed.
And sorry, what was the name of it again, please?
It's called The Agenda.
The Agenda.
By Oracle Films.
And it's
on multiple platforms, but I saw it on YouTube.
Right. Okay. Great stuff. So, Richard, you mentioned a few trading books that you thought were very valuable, but I don't want to sway your opinion or your pick. But if you wanted to give us yours.
Well, can I give you two? I'll give you
give us as many as you
non-market
like.
related. Selfishly, I'll name the Trader's Handbook. It's a project that we worked for well over a year on, combining the knowledge of not just my knowledge, but our combined 60 plus years of the author's knowledge in the market. And I think what differentiates is that it is laid out in a very clear-cut way. It's a fun read. We kept it very simple language, but in depth in terms of the concepts. And like I mentioned earlier, with each chapter, we have exercises that go along with it to help keep it very interactive, help you apply the concepts we're teaching. And in addition to the book itself, we actually, free along with it is access to webinars we've recorded on each of the topics, going sometimes 3 hours into even more depth on edges, setups, risk management practices, sell rules, all of that. And we also have included, I think at this point, 6 model books focused on breakouts, pullbacks, gappers. So all the setups we talk about, we kind of have an associated model book along with it with, 50 plus examples, some of them 100 plus examples going back in recent history of the setup itself. So, we put a lot of time and effort into this, and I think it's a really good resource, especially if you're in your first few years of trading. I think it will instill a lot of great foundational skills and concepts that, we've internalized and, as a direct result of all my interviews with market wizards and how they approach the market. So that's my book pick. My other pick, non-markets related, is just for anyone really interested in AI and just a really fun documentary. This is a little bit older. It's AlphaGo. I don't know if you guys have heard of it.
I've seen it. Yeah.
Yeah, it's fantastic. It's basically the story of Google DeepMind's quest to create an AI system for Go, the game Go, and it's just really fun. It gives a cool look at AI from
fun and terrifying, I would say.
Exactly. But I enjoyed it. Again, my background's in mechanical engineering. I did study machine learning as well. Really fun. Fun and terrifying is great. Whatever describe it. But yeah, those would be my 2 picks.
I was watching a podcast, The Diary of the CEO, which I find really helpful.
Great podcast.
Really great podcast. And there was one with Dr. William Lee, who is who's a proponent of using the right type of food. He just lists all the foods that really help your body, and it's quite amazing what certain foods do and how helpful they are at just keeping your health on the right track. And it's kind of like a very simple thing to do. And what I really liked about it was, it's not biased in any direction, because clearly he's not getting anything from, any one area. He's not trying to sell those foods. He's just saying these are these foods that you should consider. And it's also, there's the book that he's got. I bought the book that's based on it, which is called Eat to Beat Disease. And it's quite a big book. And the first half of it is actually all the science behind it, which I kind of flick through very quickly. But there are pockets of it that are just absolutely fascinating as to what certain foods do for you and how they help you. But this other one is, I guess, when people talk about AI and how AI will take over certain areas, like people have said this when it comes to music and how you can create music using AI and all that sort of stuff. And I'm like, yes, but there's this human connection that you just can't get from, when you go to a concert, you don't want to see an AI concert, you want to see a real band. We connect with people. And I don't think AI can replace that, even if it helps those people write good music. There's a band that I've come across in the last few months called The Warning. And it's 3... they were a band that came out of the lockdown, and 3 Mexican girls, sisters, who played Enter Sandman. And it's just one of those brilliant things on the internet that went viral. And from that, they've become, a world touring band, and there is a concert that I just think is outstanding of theirs. It's, if you're into heavy metal, if you're into rock, you have to watch live at the Pepsi Center, and you will keep coming back to it. But the drummer is fantastic, and she does this piece on the piano, which she's so emotional halfway through that I would defy anyone to watch that and not completely choke up, which I do. It's just like I can't. And that to me epitomizes why AI won't take over the entertainment industry, and why we will always have that connection with other human beings. But maybe I've got that wrong. But if you're into metal, if you're into heavy rock, you got to see these girls play. They are absolutely outstanding, and I'm sure you're really going to enjoy it. So it's The Warning live from the Pepsi Center. I'll put links in, and if you enjoy it, please let us know. And if you enjoy any of the picks, please let us know, because on Spotify we can now get comments and feedback as well as YouTube. So it's always good to hear what you like and whether you've got media picks that we should follow. But Richard, it just leaves me to say thank you so much for coming on the show. It's been such a pleasure, and it's really great to hear your energy. From learning your knowledge to getting it out there, I think that's got to be the shortest time I've ever heard of somebody doing that, but you've done a fantastic job of it. It's a great book. Remind us where you can get it from and what your links are and your handles.
Yeah, sure. Well, first of all, thank you so much for having me. You guys are fantastic. I wish I had your smooth podcasting voices. You guys are awesome.
It's all AI. It's all AI.
It's all AI. You should be able to find the book on Amazon. Is probably the best play. Amazon UK for those in the UK. And my handle on X, on Twitter, is at Richard Moglen. That's Moglen. There's also the company's handle at TraderLion_. So TraderLion_. And you can also visit traderlion.com for all our education resources. There's a lot of free stuff on there, as well as on our YouTube channel. And also deepview.com is the charting software, screening software that we're developing as well. That's deepview.com, DEEPVUE.com. But yeah, thank you guys so much again for having me. If anybody has any questions, feel free to reach out to my email, richard@traderlion.com. Happy to answer anything, or help point you guys to the right resources. So thanks again for having me.
Thanks, Richard.
Thanks, everybody. This podcast is for entertainment purposes only. Please do your own research or contact a professional advisor.